Hi everybody, Boris from Big Forex. Welcome to our Forex weekly technicals for 217, 222 of 14. No love for the dollar. And certainly this has been a week where the dollar definitely got battered and bruised all the way around. You take a look at the euro, which surprised a tremendous amount of people by rallying away from 35 all the way through to 37 as we pretty much close out the week here. The euro does come up against some pretty interesting resistance here above the 37 level. But this 37.38, definitely very chunky. It's going to be a little bit more of a challenge for it to decline. But for now, all signs kind of point up at this point. So unless we sort of fail at the 37.50 and come back down, the path of least resistance for the euro seems to be up, which is really surprising given the fact that, of course, the Eurozone economy continues to be very, very lackluster. Although we see glimmers of hope, and I think maybe perhaps that's the key thing. To, this upcoming week, we have the PMI flash PMI data out of the Eurozone. If that proves to be positive, it could be enough to push us into this 37, 3800s zone and just simply pure momentum. Given the trade, though, it's really not a trade that that I think has a tremendous amount of extension, because if you look at the chart going back all the way 4 or 5 months, certainly the 37, 38 is a big resistance area. Even the flame out here in the end of the new year, basically just before the new year, is consistent with the idea that 37, 38 invites a lot of sellers into the Eurozone, and it certainly looks more like a sell rather than a buy into this zone. But if it clears above these levels, if we go to 38.50, 39, certainly you're wrong, and I think the charts are going to turn quite more constructive at that point. Having said this, though, for now we're probing and testing this 3700. 37.38 is the next zone of attack for the longs, but I do think at least some corrective action is definitely going to be happening around this area, and perhaps, well, not my typical type of trade, but given the chart patterns here, perhaps a sell rather than a buy is more in order. Dollar yen, on the other hand, is very ugly. We had a big spike down in the NFPs to 101.50. The big spike down over here was sort of on the massive risk aversion flows. Trade back up this week and really just died out. We couldn't even make it up to 103. The story behind dollar yen is that the story of the U.S. economy has really slowed down due to concerns over the very, very bad weather on the East Coast. We're not seeing the kind of traction and growth in Q1. The market is starting to discount the potential of Q1 growth here. Yields in the U.S. are staying relatively depressed, and all of this, of course, leads to a negative dollar yen construct. Having said this, though, we've tested 101.50 several times, and I think this is going to be a very, very key battle test next week. If 101.50 kind of holds, we may be building enough of a momentum here for a base and a potential re-rally back up to 103.50, 104 level. Basically, this would be a corrective phase. Especially, this would be very, very critical. If 101.50 holds and we start to move back up, it would really form a higher low, a very, very bullish construct that suggests that we could be rallying back up into the 104s, 105s. On the other hand, we start breaking 101.50s. The next level of support, of course, is going to be the 150, and that could potentially be a double bottom here. So there is one last level of longs that they can hold the yen at. But still, a break of 101.50 would really open up a week to a very negative dollar flow, and it's very much worth watching as the week progresses. The pound, on the other hand, has just been nothing but buy. We took out the yearly highs. It's been a bull move, a very, very strong bull move, and I think now that we've come to these 67.50 level, there is potentially here possibility for pause. If we go back out to here like three years, we can see that we start to have modicum of resistance. Actually, I think it's going to have to go a little bit further. Let me go to the weekly on the 10 years. And we can see that there's a little bit of a modicum of resistance here. Oh, where are we? Around 67.32, this area right over here, which, by the way, we're testing right now. Clearing this, though, it really is kind of interesting. You're basically seeing on a very, very long chart. I think I'm gonna have to go to monthlies. Let's go to the monthlies just to really get crazy here. And you can see on the monthlies, and I'm just gonna zero in a little bit. Here we go. So on the monthlies, you can really see how we've built this big shelf. And I think perhaps the most interesting thing on the charts, as far as the pound goes, is that a break above the 67.50 and a small consolidative correction back up to 6,500 really sets us up for a potential massive wave move to as high as possibly 175. We haven't been to 175 since 2008, since the glory days when pound was 2 to the dollar. So this idea that UK economy continues to operate on all cylinders, that UK monetary policy is definitely going to be tightened first before the US monetary policy, really starting to get reflected in the pound. And I think the more interesting story here is a shockingly surprising possibility of a breakout in pound. But that may be a little premature. For the time being, in the next week, as we're looking at these levels, certainly this is a level of relative resistance, and perhaps even if we overshoot by 100 points, some corrective action looks to be possible. If we look in the dailies here back again, the corrective action that probably takes us back towards the 66, maybe even 65 support level as a possible correction of the wave. But still, overall, pound looks very, very strong. The breakout here is pretty significant, and we could have a runaway market. So I'd be cautious. I would not want to be short this above 68.50 if it starts to run away at this level, because then the squeeze towards the 170 will just become a self-fulfilling prophecy. Aussie, on the other hand, of course, had negative news this week. Australian employment really kind of came in negative for the third time in a row. But what's fascinating about this is it was able to shrug off the negative news relatively well. We held the 89. 89 remains now sort of the Maginot line for this particular set. Basically, the market is cautious but not utterly negative Aussie. Aussie has certainly been hugely sold down. There's a tremendous amount of shorts here. And it basically sets us up for a potential short squeeze, because all of the late shorts and all of the shorts that still believe that the Australian economy is going to go up to hell in a handbasket, and therefore ultimately is a secular short that deserves to go to 80, may find themselves in a very, very uncomfortable squeeze through 91, through 92 on a way up. So again, while there is little fundamental reason to want to get long Aussie, there could be a very interesting sentiment reason, as the short squeeze just simply pushes us up through 91s and perhaps even all the way out to 92s. Definitely worth watching. The corrective action in Aussie this week was very good for anybody who traded Aussie on the crosses on the weak side. But now, as the pair remains relatively well bid, I would caution, and I would say that you only want to get interested in Aussie on the short side if we give up the 90. If we give up the 90 and sort of end below 90 on a closing day basis, that would suggest that perhaps we have further weakness to go. And Aussie as a component to the short side on the crosses becomes an interesting trade. But for now, Aussie is a short squeeze, and you don't want to be in front of a short squeeze. Dollar CAD had a pretty good week this week, actually. Broke down below the 110 level and certainly traded well. But today we had negative data, and the whole idea of this massive snowmageddon, which has been the story of North America this winter, may be starting to spill itself over into Canada as well. Because remember, Canada is very sensitive to North American trade, North American flows. So this corrective action off the 112, maybe finally finding a little bit of a support here. Certainly we broke out 109. 109 was the big breakout. We reached 112, so retrace back to underneath 110, right above 109, suggests a potential re-rally back up to 111. So Aussie, to the downside, Caddy to the downside could be an interesting trade here. And certainly when you're looking for cross ideas, pound CAD, Euro CAD, let's take a look at just the pound CAD on a complex, is one of those trades that's really starting to gear up towards the fresh yearly highs. I mean, Caddy getting very, very weak above this 86 level would be a big breakout for pound CAD, and one that's really worth watching. Last but not least, let's take a look at the Kiwi in the commodity complex. And the story here is just quiet. We're up at the upper ages, but that's because we've sort of, all the com dollars got pulled up a little bit. Kiwi definitely has this shelf of resistance between 83 and 84, basically 83.50, 84.50, with this spike just underneath 85.50. So one of the key things I think that would really rock Kiwi higher is a definitive move towards higher interest rates in the March decision, which we're still a little bit far away from, which would then effectively put it on a course of a tightening monetary policy and maybe unburden the market of this range basis. And the other thing is, of course, if we continue to see really decent data out of China, we have Chinese data at the end of this week with HSBC manufacturing PMI. If that comes back up into positive territory, that could sort of allay all these fears that Asia is having a major stall and give Kiwi a further boost. But generally, it's really going to be interest rate driven. We need to see less talk, more action out of RBNZ. RBNZ actually needs to step up and raise rates, which would, in that case, once the rates are raised, would attract tremendous amount of speculative flow into the trade because it would already pay high interest rate, and that could push us through this 84.50, 85. These are the key levels to watch, obviously, as the next couple of weeks progress in terms of the breakout to the top side. But for now, this is a stall on the upper end of the channel as far as we look. Now, looking at the crosses. The couple of interesting ideas that I saw in the crosses, I think, was obviously pound CAD as we're starting to break out the pound story. Pound Aussie also a good trade to the upside potentially, not as strong as pound CAD because Aussie is not nearly as weak. And here's the interesting thing, and this is where I'd be a little bit cautious. If Aussie starts to squeeze out higher, right, Aussie actually becomes the buy side of the cross trade, and you can look at a couple of things. Certainly, we've seen the caddy get a little bit weaker. Aussie getting squeezed out, becoming the buy side of the cross trade means a break above a parity on Aussie CAD could put us basically to 101 on a potential breakout move, and that could be one of the more interesting side trades as next week begins to develop. Monday is obviously going to be a holiday, but the rest of the week should be a lot of fun. We're going to be at the New York Traders Expo, both Kathy and I, Monday and Tuesday of next week. So if you're in New York, we'd love to see you in person. Best of luck and best of trading. This is Boris Lossberg for BK Forex. Over and out.